Joining us now, Craig Siegenthaler. He's a research analyst at Credit Suisse Holdings. Craig, thanks so much for joining us. And the improvement in equity and bond prices, the big reason here, no doubt?
It's definitely a big reason. What we saw in the fourth quarter were markets returning to normal, equity markets rising, bond prices rising. That had a positive effect on asset manager earnings estimates. And actually, this is the third straight quarter we've seen this. The magnitude's a little lower, although in most cases we're still expecting EPS beats out of the asset managers. In 13 of the 15 stocks, we actually took up estimates.
Craig, you say 3 quarters in a row. Is this giving you hope going forward? You know, a lot of people say when you see a couple of quarters of sustained growth like that, they don't want to get too giddy. They want to put on the brakes a little bit and stop from popping the champagne corks. But are you seeing a trend here now?
Well, what we're seeing really, I think, is the kind of de-thawing of the liquidity crisis. As we move money from money markets to deposits to fixed income, and it's starting in government fixed income, shifting to corporates to emerging markets, it's going to wind up in equities one day. And our bet is 2010 is going to be the year of equities, where we get improving flows, not just in international and emerging market strategies, but also on the domestic equity side. So better flows on the equity side means higher fees, and it's a positive for the asset managers.
Craig, I want to get back to fixed income for just a second here. Did JP Morgan's numbers on fixed income today give you any pause about raising estimates specifically for that group for the asset managers?
Well, when you look within the business at JP Morgan, you look at their asset management subsidiary, because they have a very big asset manager there. They had money market outflows, but their equity and bond business did very well. So I think that actually supports our thesis for money market outflows, strong bond flows starting to slow a little bit, and money shifting back to equity flows. A lot of investors have been burned, and they feel more comfortable with the income of fixed income products. But the problem now is spreads have tightened and yields are tight, so they're going to look for returns in other areas. Equities give you the highest return. Emerging markets, international and globals leading. We think domestic equity will also follow.
Okay, what about Franklin then, Craig?
Well, Franklin, when we looked at the numbers, because they just released AUM a few days ago,
right,
their international bond and it looks like their taxable bond flows were very, very strong. We took our fixed income, we took our total net flow estimates up to $16 billion, which is even better than a very strong third quarter number of $12 billion. So we're expecting both strong flows out of Franklin and also strong earnings. We're looking for at least an 8-cent beat on EPS out of Franklin Resources.
And what about T. Rowe Price? This is a company that's out in a couple of weeks with its earnings. I mean, when you're looking at these asset managers, what sort of differentiates them? Why, Franklin Resources versus a T. Rowe, for example?
Well, we actually have an outperform on T. Rowe. We really like the T. Rowe stock over 1 year. We upgraded in November. The stock's been the best performer up until now. Franklin performed in line with the asset managers. We have a neutral there, but we're making a 2-week trading call long Franklin into earnings. But what you focus on in earnings season when you're analyzing asset managers really simplistically is 2 things. Focus on net flows and organic growth, because that gives you your reoccurring revenue growth. You also focus on operating earnings. So you back out the noise and say, what was the true earnings power there? So if T. Rowe and Franklin beat on those 2 metrics, generally the market's going to reward them and lift the stock prices.
Craig, I happen to be looking at some numbers today from the Investment Company Institute, which looks at the flows, the very flows that you've been talking about. And as you've been saying, really we have seen an overwhelming flow into the bond funds and out of particularly domestic equity funds. And you talked a little bit about the shift, that shifting. What do you think is going to be the catalyst, though, that is really going to start to change that?
Well, there's a few catalysts this year. One, I think, money market flows keep leaving because there's no returns there. There's no yields there. So where does that go? It first went to bank deposits. Second stop is fixed income. Right now, international and global fixed income bond flows are getting the most inflows, and they're actually the riskiest area of the bond market. The next stop should be equities. International emerging market equity funds are doing well. ETFs are doing well. The one place, as you mentioned, that's not doing well is domestic equity. We actually don't see big net inflows there, but if you look at the rate of improvement in the net outflow, we think domestic equities, in terms of the redemption levels, should improve. But also the key catalyst is, when does the Democrats or when does Congress raise taxes? When taxes go up, investors are going to be looking for better after tax returns, and we think that'll actually shift money from taxable bond to muni bond flows and even equity tax efficient investments.
Craig Siegenthaler, Credit Suisse Holdings, joining us. Craig, thanks.